Your money-making broadcast starts now. Markets closed this evening with a mixed session for Canadian investors. The S&P 500 pushed near record highs, while the Nasdaq hit an all-time high on a semiconductor-led rally, but Canada's tech flagship suffered a devastating blow. Shopify, the country's largest company by market cap, cratered 15% after issuing underwhelming Q2 revenue and operating income guidance that sent shockwaves through the TSX. Meanwhile, crude oil held above $105 a barrel, diesel prices breached the $5 mark, and shipping costs are spiking across North America. Let's break down exactly what happened in today's session, and what it means for your portfolio. Let's start with the biggest story of the day for Canadian investors, Shopify. The Ottawa-based e-commerce giant plunged 15% in today's session after management issued Q2 guidance that fell well short of consensus estimates. Revenue guidance came in below expectations, and the company signaled compressed operating margins for the current quarter. This is a massive counter-trend move for a stock that had been riding the AI-driven tech wave alongside its U.S. peers. Now, the world's leading innovation-focused fund manager, Cathie Wood, would likely see this sell-off through a different lens. She would argue that the structural thesis for Shopify has not changed. Merchants continue to flock to the platform, global e-commerce penetration is still climbing, and Shopify's AI-powered merchant tools are deepening its competitive moat. A 15% single-day drop on a guidance miss, from her perspective, creates the kind of entry point that long-term growth investors wait for. Whether you agree with that view or not, today's action in Shop is a reminder that even Canada's best tech story is not immune to quarterly earnings volatility. Moving to the semiconductor sector, Intel surged 13.2% today, pushing its market capitalization past Oracle for the first time in years. Intel now commands over $108 a share as the market continues to reprice semiconductor stories on the back of AI infrastructure buildout. The legendary growth stock investor, Phil Fisher, would be watching Intel's transformation closely. He would focus on whether Intel's foundry turnaround is gaining real traction, not just on the stock price reaction. Fisher famously said that the real money in growth investing comes from identifying a company's fundamental transformation before the market fully prices it in. Intel's foundry business, its chip design pipeline, and its exposure to the AI data center cycle all point to a company in the early stages of a multi-year turnaround. For Canadian investors holding Intel through the TSX or US listings, this rally validates the patience required for deep-value semiconductor plays. On the energy front, crude oil remains the dominant macro story for the TSX. West Texas Intermediate crude settled at $105.23 per barrel, sliding slightly from earlier highs, but still at levels that directly benefit Canadian energy producers. Suncor Energy, ticker SU, Canadian Natural Resources, and Tourmaline Oil all stand to benefit from sustained $100 plus oil. However, the flip side of elevated energy prices is showing up in the logistics sector. Diesel has now surpassed $5 per gallon across much of North America, and the U.S. Bank Freight Index confirms that transportation costs spiked sharply in Q1. UPS dropped 10.5% today on concerns that higher fuel costs and softer parcel demand are compressing margins. For Canadian exporters who rely on ground and air freight networks, these rising costs represent a direct headwind that will show up in Q2 earnings across multiple sectors. The father of modern value investing, Ben Graham, would counsel investors to look at the companies being unfairly punished by these crosscurrents rather than the ones being celebrated. When logistics costs spike, short-term panic often creates mispriced assets for those patient enough to analyze the underlying earnings power. HSBC also made headlines today with a Q1 earnings miss driven by £1 billion in unexpected credit losses. The UK-headquartered bank has substantial commercial and retail operations across Canada, and its credit quality deterioration raises questions about whether Canadian banks might face similar pressures in their upcoming earnings seasons. While Canada's big six banks have so far shown resilience, HSBC's miss serves as a reminder that credit cycles can turn faster than consensus expects. The legendary Fidelity fund manager, Peter Lynch, would approach this by looking at what he understood best. He would ask, are Canadian households and businesses showing the same strain that HSBC saw in its UK and Asian portfolios? So far, Canadian consumer credit metrics remain manageable, but today's HSBC result is a warning flag that bears watching. On the nuclear energy front, Cameco and BWXT Technologies are both testing by points on their latest earnings momentum. Cameco, the Saskatoon-based uranium giant, continues to benefit from the global nuclear renaissance as governments and tech companies alike seek emissions-free baseload power for AI data centers. Microsoft's recent power purchase agreements tied to restarting 3 Mile Island and Amazon's acquisition of a nuclear-powered data center campus have supercharged the nuclear thesis. The pioneer of global contrarian investing, John Templeton, would recognize this as an industry that most investors have ignored for a decade. He built his fortune buying what was unloved and waiting for the cycle to turn. For Canadian investors, Cameco remains the purest way to play this theme with a home country advantage. Elsewhere in today's market, Palantir Technologies fell 6.79% despite reporting record Q1 revenue, a reminder that even strong execution can be punished when expectations have run too far ahead. AB InBev surprised to the upside with a sales surge, showing that consumer staples with pricing power are finding favor in this environment. And PayPal beat earnings estimates, but saw its stock decline on cautious commentary about online payment volumes in the second half of the year. The broader U.S. market composite, tracking 103 stocks across all sectors, finished up 0.58%, confirming that today was a selective market, not a uniformly bullish one. The new Anthropic AI venture backed by Goldman Sachs and Blackstone to the tune of $1.5 billion underscores that institutional capital continues to flow aggressively into AI infrastructure, a theme that benefits TSX-listed tech and power names indirectly. Now let's get to the stock picks that deserve your attention after today's session. First up, Enbridge, ticker ENB, at roughly $42 a share. This is Canadian energy infrastructure at a price that yields over 6%. With crude at $105 and Canadian oil production hitting record levels, Enbridge's pipeline network is running at full utilization. He would categorize this as an understandable business with a durable competitive advantage and a dividend that grows every year. The key catalyst here is that the market has not fully repriced ENB for the higher for longer oil environment, so you are buying a toll taker on Canadian energy at a discount to fair value. Second, Cameco, ticker CCJ, at roughly $70 a share. This is the nuclear uranium story I mentioned earlier, and it remains one of the most compelling Canadian growth themes for 2026. With AI data center power demand driving a structural increase in uranium contracting, Cameco is sitting on the largest uranium production capacity in the Western world. He would appreciate that nuclear was the most hated energy sector just 3 years ago, and now it is being rediscovered by institutional capital. The earnings momentum from BWXT and CCJ this quarter confirms the thesis is real. Third, Pfizer at just over $26 a share. This is the defensive value play in today's portfolio. He would look at Pfizer's book value, its trailing earnings, and its dividend and see a classic margin of safety. The stock has been left for dead by the market as its COVID revenue fades, but Pfizer's pipeline of non-COVID products, its cost-cutting program, and its strong balance sheet mean that the earnings floor is higher than the market currently prices in. At under $27, this is a blue-chip pharma stock with a dividend yield of over 5%. And finally, Shopify, where we now have a genuine contrarian opportunity. After the 15% crash today, he would be studying the details. Was the guidance miss driven by a structural problem or by temporary factors? Early analysis suggests Shopify's core merchant growth remains healthy, and its AI tools are gaining traction. The guidance disappointment appears to be timing-related rather than a broken business model. For investors with a 12-month horizon, today's panic creates a potential entry point into Canada's best tech company at a discount. But remember, this is a high-conviction, high-volatility play, not a conservative allocation. The bottom line for today, May 5th, the TSX is dealing with two powerful forces. High oil prices are a tailwind for energy and pipelines, but rising freight costs and credit deterioration in the banking sector are headwinds. Shopify's crash is painful for Canadian tech believers, but it may also be the best buying opportunity of the year for those with patience. Focus on quality businesses you understand, keep cash for opportunities like today's shop sell-off, and remember that the market is always pricing in tomorrow's news, not today's headline. This has been Chloe with your May 5th Market Close recap. See you at 7 a.m. Eastern for shorts. Thanks for watching the Market Close recap. If you found this helpful, subscribe and hit the bell so you never miss a session. I'll see you tomorrow at 7 a.m. Eastern for shorts, and back here tomorrow evening at 8 p.m. Eastern for the full Market Close breakdown. Until then, invest wisely, Canada. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.